everyone, and welcome to this video where we're going to talk about what bonds are, why people buy bonds, why you might consider buying bonds, and why certain types of entities issue bonds. To get started though, we need to gain some perspective. So when we think about bonds, there's broadly two perspectives that we need to gain. We need to see things from a buyer's perspective as well as an issuer's perspective. So let's go ahead and start with the buyer's perspective. From their perspective, bonds are just fixed income securities that you can invest in to earn interest for a certain amount of time, a lump sum payment after a certain amount of time, or both. So some bonds pay interest only, others pay only a lump sum payment after a certain amount of time, and still others pay interest as well as this lump sum payment. If we think about a generalized timeline for the payoffs of bonds, well, you would pay a price today, for example, $1,125, and that would get you a series of interest payments as well as a lump sum payment. So in this example, we've got $50 interest payments every year for N years, and then at the nth year, which is when the bond matures, you'd get this lump sum payment of $1,000. Now, we define these interest payments as coupons, and we define the lump sum payment as a par value. We'll talk more about these specific terms when we look at bond characteristics, but the key thing you need to know for now is that some bonds pay this interest payment every year or every period, as well as this lump sum payment when the bond expires. Other bonds only pay interest every year or every period, and some bonds only pay this par value or the lump sum payment. Now, in terms of why people buy bonds and why you should consider buying bonds, they're a really unique financial instrument, mainly because they have a legal obligation to pay you the promised payoff, be that interest only or just the par or both. Whatever they promise you at the time of issuance, they have to pay you that, so it's a legal obligation. If we think about stocks, on the other hand, they have absolutely no legal obligation to pay you anything, not even dividends. Contrary to popular belief, stocks don't have to pay you dividends. They can choose to pay you dividends, but by no means are they obligated to do that. And even those stocks that pay you dividends at the moment don't necessarily have to continue paying those dividends, so they can stop paying it whenever they fancy. Of course, there will be consequences if a dividend-paying stock suddenly decides to stop paying dividends. The stock price would likely decrease, but that doesn't change the fact that they have absolutely no legal obligation to pay you anything. And given that bonds do have this legal obligation, they're essentially a relatively less risky security vis-a-vis stocks. And given that they are relatively less risky, you can decrease your overall portfolio risk by investing in them. And to see why this is the case, let's consider an example with two scenarios. In the first scenario, you only invest in stocks, or more specifically, you only invest in this one company, which, by the way, is one of the most ridiculous things anyone can do. So you should never put all of your money in one company or one stock. But just for simplicity, let's say that you put in $1,000 today in ABC PLC. And then in a year's time, the economy could either go into a boom or a recession. And if it's a boom, your portfolio will be worth $1,500. If it's a recession, it'll be worth $500. In other words, if it's a boom, the stock increases by 50%. And if it's a recession, the stock loses or decreases by 50%. So in this very simple example, by investing in this one stock, you expose yourself to the risk of possibly losing up to 50% of your money. Now let's consider another scenario where you invest in this stock as well as a bond. So exactly the same stock, but rather than putting $1,000 in the stock, you're going to put $500 in this stock and put another $500 in some bond. Again, we could either have a boom or a recession, and if it's a boom, the stock will increase by 50%. If it's a recession, the stock will decrease by 50%. Now, given that bonds are less volatile compared to stocks, we're going to make a rather simplistic assumption that the price of the bond remains unchanged. And as simplistic as this assumption is, it's not the most ludicrous assumption on the planet. So just for simplicity, we're going to assume that the price of the bond remains at 500 or very close to 500, regardless of whether it's a boom or a recession. And so if that is true, your portfolio will be worth $1,250 in the event of a boom and $750 in the event of a recession. How do we get these numbers? The stock increased by 50%, so that would trade at $750. And we said the price of the bond would remain unchanged, so that would still be $500 here. So you'd have $1,250 in total. In the recession case, we said that the stock would decrease by 50%, so that would trade at $250 now, and the bond would still trade at $500. Now what's interesting is that in the boom, your portfolio would increase by 25%, but in the recession, it would only decrease by 25%, as opposed to 50% that we saw previously when you invested all of your money in this one stock. So you can see just by investing in this bond, you've halved the risk of the downside. Now, of course, you've also decreased the upside, but generally when you're investing in things, the upside takes care of itself. We don't need to worry too much about things going up. Because, when you're in a boom, you're going to earn a decent return. A huge part of the investing process is managing the downside. And by investing in bonds, you can decrease the downside. You can mitigate the downside. And additionally, by investing in these relatively safer securities, you put yourself in a position where you can afford to invest in other riskier asset classes. So by including bonds in your portfolio, you can invest in riskier asset classes without exposing yourself to too much risk. And this is because of the effects of diversification, which is a very fancy word for essentially saying don't put all of your eggs in one basket. Don't invest all of your money in one stock, or even one industry for that matter, or one asset class. Alright, so hopefully you've kind of understood what bonds are, i.e. that they're fixed income securities. And by the way, they're called fixed income because the income that you earn from them is fixed. If we think back to our timeline, we were getting $50 every year for N years. And so the coupon that you're earning, or the interest that you're earning, is fixed, as is the par value that you're going to get. It's fixed in time. So you know exactly what you're going to get. Hence, we call it a fixed income security. Now, this definition, of course, holds from the buyer's perspective. Let's now take some time to understand what bonds are from an issuer standpoint. So from the issuer's perspective, a bond is just a loan, aka a debt instrument. And that makes sense, right? We said that you, as the buyer of the bond, would earn interest for a certain amount of time, followed by this lump sum payment. Well, who's paying you the interest? It's the issuer of the bond. And why would anyone pay interest? Because they've borrowed money. That's the only time you normally pay interest. So a bond is then just a loan, whereby the issuer of the bond pays some interest and or this principal or par value, depending on what they've promised you at the time of issuance. So the issuers of the bond are borrowers, and they tend to be governments and large corporations. And when we think about the purchasers or the investors, well, they're the lenders. So when you buy a bond, you're technically lending money to the issuer of the bond. And when you issue bonds, you're borrowing money from investors. So from the issuer standpoint then, bonds can be seen as a source of finance. If we think about when firms want to raise money, well, they can either go to the bank or go to equity markets, where they would issue shares in their company in exchange for money. So they would give up a certain stake in the business in exchange for cash. Lastly, they can go into debt markets, wherein they would issue these bonds or other fixed income securities in exchange for money today. Likewise, if we think about governments, when they want to raise money, they can either print money, although this has major consequences in terms of the value of the currency, as well as money supply and a whole host of other issues that come up. But that's for an economics course anyway. The other thing they can do is to increase taxes. But this also has consequences, right? Because you don't want to increase it too much, because you'll end up disincentivizing investors and entrepreneurs from operating in the economy. So the other way they can raise money is to go to debt markets as well, and they can issue what are called government bonds, or treasuries if you're in the United States. In the UK, bonds issued by the government are called gilts. The term is going to vary from country to country, but in essence they're just bonds. Perhaps a more important question though is, why should firms and governments issue bonds? Well, ultimately they should do so to finance investments in positive NPV projects. When we say finance investments, we mean raise enough capital to fund these projects. Now, what are positive NPV projects? In a nutshell, they're just projects that we expect to earn money from, given a whole host of risks, such as the time value of money, firm-specific risk, or project-specific risk, or market risk, etc., etc. So, conditional on incorporating all of these risks, if a project has a positive NPV, then it's worth pursuing. And so governments and large corporations should only issue bonds when they want to finance these positive NPV projects. Alright, so hopefully that makes sense. In summary then, we've learned that bonds are fixed income securities that pay interest, which we call coupons, and or a lump sum payment, which we call a par. Remember, we said that they're called fixed income because the income that you get from them, the income that you earn from these bonds, is fixed. So you know it well in advance, and they have a legal obligation to pay you these promised payoffs. Additionally, we learned that overall portfolio risk can be decreased by investing in bonds because of their known payoffs and their less volatile nature. Finally, we learned that for issuers, bonds are essentially just loans, which they should issue only when they want to invest in positive NPV projects. Hopefully that makes sense and you've got a bit of an understanding of what bonds are. Over the next few videos we'll go deeper and learn more about bond characteristics, the payoffs and timelines of bonds, the different types of bonds. We'll also learn about bond ratings and how they work, and once we've got all of these basics right, we can go still deeper and learn how to value bonds. Alright, that's enough from me for now. Have a go at the quiz and I'll see you in the next video.